McDonald's stands out as a global fast food leader, but could its financial strength be hiding potential risks? In this analysis, we'll explore whether rising debt and liquidity concerns threaten investors, despite strong profit margins. We'll examine their balance sheet details and strategic decisions that could affect future growth. Ready? Let's begin. Examining McDonald's balance sheet, we see a significant increase in cash on hand, from $792 million to $1.221 billion, indicating strong cash generation. However, total debt has also risen, causing the debt-to-equity ratio to inch up from 0.829 to 0.835. A higher debt-to-equity ratio means the company is using more debt relative to equity, which can heighten financial risk. Retained earnings have decreased slightly, possibly due to ongoing share buybacks totaling $67.676 billion. While buybacks can boost shareholder value in the short term, they reduce funds available for future growth. As value investors, we should consider whether this increased leverage supports sustainable long-term performance. Looking at the full balance sheet, a critical imbalance emerges. Current liabilities are rising dramatically, suggesting potential liquidity issues. In particular, short-term debt warrants close scrutiny, as it may affect McDonald's ability to meet immediate obligations. McDonald's demonstrates strong financial health with high retained earnings relative to its market cap, outperforming over 80% of industry peers. However, its high debt-to-equity ratio and low cash position are concerning, as it falls behind in liquidity compared to both the industry and the S&P 500. Analyzing McDonald's recent income statements, we notice a slight dip in gross margin to 56.38%, likely due to rising raw material costs. Effective cost controls have mitigated some of this impact. Meanwhile, the net income margin improved to 32.81%, reflecting successful pricing strategies and increased sales volume. The significant rise in EPS to 0.34 suggests benefits from share buybacks and operational efficiencies. Management remains cautiously optimistic, expecting revenue growth from new product launches and market expansion. However, they are aware of ongoing cost pressures from inflation and supply chain disruptions. Sustaining profitability through operational improvements is crucial amid these macroeconomic challenges. Reviewing the full income statement, we see that McDonald's operating income increased to $3,188 million, evidencing effective cost management despite slight operating expense pressures. This growth, surpassing competitors, indicates resilient profitability, yet staying watchful against rising interest expenses is essential for sustained success. McDonald's net income margin is outstanding, surpassing 90% of industry and index peers. Its SG&A margin is above average, better than 55% of the industry and 66% of the S&P 500. However, EPS growth is average within the industry, but lags at the S&P 500, indicating room for improvement. McDonald's has shown a solid upward trend in revenue and net income over recent quarters. Revenue grew from $6.17 billion in March 2024 to $6.87 billion in September 2024, reflecting increased demand and successful product launches. Net income rose from $1.93 billion to $2.25 billion in the same period, indicating effective cost management even amid inflationary pressures. The company's focus on digital transformation and expansion into emerging markets has strengthened its revenue base. While there are risks from potential increased competition, the enhancement of digital capabilities positions McDonald's well for sustained long-term growth. This financial performance suggests a robust foundation for future profitability. Examining McDonald's cash flow statement reveals a significant improvement in free cash flow, rising from $1.062 billion in June to $1.942 billion in September 2024. This increase suggests better operational cash management and stricter credit policies, enhancing collections. The free cash flow yield strengthened to 0.92%, indicating strong potential for shareholder returns. Despite higher capital expenditures aimed at boosting technology and production capacity, the CapEx margin slightly decreased to 35.21% from 37.14% in December 2023. This reflects a strategic focus on long-term investments. Balancing immediate financial performance with these initiatives is crucial for sustained growth. Reviewing the full cash flow statement, McDonald's significant investment in capital expenditures, marked at $794 million, indicates strategic expansion efforts. However, the noticeable decrease in cash provided by operations down to $2,736 million could signal potential challenges in maintaining consistent liquidity. In McDonald's recent earnings call, the company highlighted decisive actions to address food safety issues after E. coli cases were linked to their slivered onions. By halting supplies from the affected vendor and tightening safety protocols, they aim to rebuild consumer confidence. Despite industry challenges, especially in Europe and regions impacted by geopolitical tensions, McDonald's posted positive U.S. comparable sales. This uptick stems from value-driven offerings like the $5 meal deal and innovations such as the Chicken Big Mac. Notably, they announced a 6% increase in the annual dividend, the 48th consecutive raise, which often signals strong financial health. The planned launch of a new U.S. value platform in Q1 2025 could further enhance their competitive edge. Analyst estimates forecast that McDonald's will continue to show steady earnings growth, reflecting its strong brand and global presence. Though revenue growth may be moderate due to market saturation in established regions, the company's focus on technological innovation and menu customization could drive future expansion. Compared to industry peers, McDonald's stable cash flows and dividend payouts make it an attractive option for value investors seeking long-term returns. Understanding these projections helps assess the company's potential for sustained profitability in a competitive market. McDonald's scores for net income and EPS are below 35, underperforming both industry peers and the S&P 500. This suggests weaker profitability and may signal challenges in maintaining earnings growth compared to competitors. McDonald's price-to-earnings ratio of 25.49 suggests it's reasonably valued relative to its earnings, especially compared to Chipotle's 51.29 and Dutch Bros' exceptionally high 1,144.29. This indicates McDonald's may offer better value for investors seeking earnings at a fair price. The negative price-to-book ratio of minus 45.86, though unusual, results from strategic share buybacks, which can reduce book value but enhance shareholder returns. This reflects McDonald's commitment to returning value to shareholders. Its strong brand and innovation capabilities support these valuation metrics, reinforcing its competitive edge. While market fluctuations can impact these ratios short-term, McDonald's fundamental strengths favor long-term growth. McDonald's DCF valuation suggests an intrinsic equity value of $273.90 per share in the base case, offering a robust analysis relative to its current market price. Management's confidence in a 4% long-term growth rate reflects anticipated operational efficiencies sustaining free cash flows. However, macroeconomic conditions could influence the outcome. The equity value might reach $315.50 per share in an optimistic scenario, or fall to $232.81 in a pessimistic one. This emphasizes how economic factors impact valuation. Despite McDonald's strong cash flows and market position, our proprietary Bow score shows that McDonald's DCF valuation outperforms much of its industry and the S&P 500, but doesn't indicate significant undervaluation. Value investors might see McDonald's as fairly valued, offering stability rather than an exceptional bargain. Analysts forecast steady earnings growth for McDonald's, suggesting stable future returns. This consistency may appeal to value investors seeking reliable investments. However, it's important to assess whether the projected growth rate aligns with individual investment goals and compares favorably with competitors. McDonald's scores lower than most of its industry on analysts' target forecasts, indicating that analysts anticipate less price appreciation compared to peers, potentially reflecting concerns about its growth prospects. While McDonald's shows robust financial performance, strong global branding, and consistent dividends, there are underlying concerns that merit attention from value investors. The increase in total debt and a higher debt-to-equity ratio suggest rising financial leverage, which may elevate risk during economic downturns. Additionally, significant share buybacks, while boosting short-term shareholder value, reduce retained earnings available for future growth initiatives. Liquidity challenges indicated by rising current liabilities and lower cash positions could impact the company's ability to meet immediate obligations. Therefore, investors should carefully weigh these hidden risks against McDonald's financial stability and long-term growth prospects. Make sure to watch another video from our Value Explorer series by clicking the playlist below.